TSP along with everything else that you have, and look at where the best portfolio is, as well as the makeup of the portfolio. And some of that, there is no set plan for that. A lot of that will also have to do with your risk tolerance. And, so typically what we try to do is get a plan that's going to fit your risk tolerance, and unless it really doesn't work out, I can tell you that you might have to take a little more risk than you were hoping for. So in terms of the TSP, one thing I would mention is that sometimes people think of, oh, do I roll over my TSP into an IRA or do I keep it in the TSP? One thing to keep in mind is you can do partial rollovers and still keep some exposure to the TSP. I'd say the more comfortable you are with risk and managing your own portfolio, then probably the more comfortable you are keeping a bigger percentage in the TSP because of the lower expenses and if you're doing things yourself on that. But it's all going to come down to the individual situation. How you take required minimum distributions will also mix in with how you're doing what you're doing on the Social Security side and your pension, if you have a pension. So the important thing in there is going back to the introduction. It's the plan. You want to have a plan in place and a method for how you're going to approach this.
So John, you mentioned minimum distributions. So how do you plan for required minimum distributions on qualified assets? And then could you kind of go into a little bit about what is considered a qualified asset?
Sure. So a qualified asset would be an asset that's been tax deferred or in the eyes of the IRS. It qualifies under IRS regulations to be tax deferred. And typically that would be a 401k, a traditional IRA, a TSP, and eventually, the government does want to collect some taxes, so they do have to require a minimum distribution. Beginning of the year in which you turn 70 and a half, they do get a little break there on the first year. They realize some people might be a little bit late in filing for that required minimum distribution. So that first time you can actually make the withdrawal the year following the year in which you turn 70 and a half. And that way you can avoid a large IRS penalty. The penalties are pretty steep if you don't take your required minimum distribution. And the reason for that is back when IRAs came into place and required minimum distributions, the IRS really didn't have a method of tracking who was required to take a distribution and whether or not they did. So they made the penalty very steep if you didn't, 50% of what you were supposed to take out. So a little draconian, but they wanted to make sure that you followed through on your own. Now they're tracking all that, but they haven't got friendly with the penalty. So we still have to watch out for that. And just to give you an idea, when you turn 70 and a half, that first distribution, the way it's computed is they'll take the balance of your qualified assets at the end of the previous year, December 31st, and divide that by your IRS life expectancy. That's a published IRS life expectancy table. And the first year, that withdrawal, just to give you an idea, will come out to less than 4% of the assets. There are certain circumstances where you might not have to make a required minimum distribution. That would be certain 401ks might allow you to continue to defer if you're still working and you contribute to the 401k. And that's not across the board. It's really subject to each individual 401k. And those are the things that we would look into when we're working with a financial planner to find out the nuances of the 401k and the nuances of the required minimum distribution scheme. It's also, leading into that, a lot of people do look at consolidating, especially if you change jobs and you have small IRAs around or an old 401k. It can make sense as you get closer to needing to do the required minimum distribution that you start to consolidate those assets, especially if there's no real reason to not consolidate them other than you just haven't gotten around to it. And so if you have them all in one place, you also put the onus on your custodian to make sure that the required minimum distribution is computed correctly. I've never seen a mistake when you put it in their hands because they have the latest IRS life expectancy tables, and they'll make sure that you make the full required minimum distributions. But they have to know where all the qualified money is.
I think this is, does anyone want to add anything before I ask questions? Okay, yes.
One question, the qualified distribution at 17 and year, that includes standard IRA and the Roth IRA?
It does not include the Roth IRA. The reason for that is with traditional IRAs and 401ks, you have to pay taxes on those, they'd be tax deferred. And so now by starting to make the distribution, the environmental distribution, the IRS is going to start taxing you on that and get some revenue into the federal coffers. But the Roth IRA grows tax-free. You've already paid taxes on the principal that were in, the earnings are growing tax-free, and so they don't really care when you take that out. So a lot more leeway with that.
Related to that, is it the same principle for the TSP as well?
Yes.
So that you wouldn't be, you basically could keep it in there and wouldn't be touching that pot?
Yes. And if you wanted to, for some reason, you wanted to invest it differently, you still have it in a Roth, you could do a transfer into a different Roth.
Having just settled the state, the last bit was just stated, by consolidating, it makes it a lot easier on the person who has to settle it with all the death certificates, et cetera. So if there's those little accounts sitting out there, you can compile them all into one, it's a lot easier on those survivors.
Definitely. Yes, question?
On a TSP, aren't there restrictions on how many times you can withdraw from the TSP? I mean, isn't it an awkward fund to have after retirement?
You do want to make sure you manage that correctly.
I thought you can only withdraw once, and then
you'd have to move it.
and then you have to move it.
Yeah, so there are nuances to that, and you want to work with that closely and make sure you don't.
To clarify, I thought with the TSP, you can make maybe a certain number of withdrawals annual. So arguably, you could take out enough for the whole year, and then the following year, can't you then again draw out a TSP?
Yeah, you can set up for
Right,
standard payments.
right,
So there are different ways to take it out.
right.
What you're referring to, I think, is the annuity option that you can choose when you retire. Through the TSP plan, they'll offer you a few different annuity options that you can take that will start systematic payments every year to you.
With all due respect, I don't think you have to do the annuity, but you are restricted as to how many times you can withdraw annually. I think you can take money out every year, but the issue becomes, are you taking out enough to get you through the year?
Yeah, I mean, the key to that, I think, is a one-on-one basis, you know.
Okay, wonderful. I'm sorry. I will make sure to get back to the questions. I'm going to move on to the next section. So I asked in the very beginning who basically would love to retire right now. So I'm pretty sure there's still a lot of misconceptions about retirement, when you can retire, how you can do it. So we thought a fun way to kind of do to go over the misconceptions is to do a true or false game. So if you look in your folders, you will find a sheet of paper that says true or false on it. Looks like this. And those of you that are joining us online, we want you to participate too. So please go ahead and let me know if you believe the statement is true or false by typing it into the comment section. For all of us joining us in the room, just raise it up and let us know, okay?
Are there any more folders that are out?
Oh, I'm sorry. No, there you go. Okay, great. Okay, wonderful. So I'm basically going to make a statement, and then you let me know if you believe this to be true or false. Don't follow me. I'm going to play along too, and I might be wrong. So, okay. All right. So the first statement is you will not need as much income in retirement as you have now. True or false? Okay. Which way am I going to swing this? I think I'm going with false on this one. All right. It looks like the majority of people said false. Okay. So to our panelists, is this statement true or false? What do you believe?
hate to come back to, it really is an individual thing, but for most people it's probably false, but for some of you it may be true. A lot of it will depend on what you plan on doing in retirement. And part of that retirement planning, I think some people have really haven't thought about it enough, it is what are your expenses going to look at in retirement? And you need to plan for things such as if you like to travel or if you like to golf, it might be more expensive than at age 65 to 80, where you still can do those things. You know, maybe when you get, if you're living into your 90s, you know, as you get older, you might not be doing as many of those things and spending as much money on that, but you might be spending more money on healthcare and healthcare-related costs. So what I see more often than not is maybe people just underestimating just how expensive retirement might be.
I made that example early on that a lot of times we see people go into retirement and then they go back to working again because they run out of money. So that is something to definitely consider when you're thinking about retirement. Do you want to add something?
And, well, the traditional model is that it's assumed you need less because you already have the house, the car, the clothes. There's not a lot more toys to buy at this juncture. But the one thing that we'll talk about later is that, and again, if everything goes well and you stay healthy, it's probably your expenses probably will stay low. But the greatest risk that is out there for everyone is a unfunded chronic condition. Bill has a stroke. Bill gets dementia. That's where the big costs come in. We'll talk about that later. But if you're fortunate enough to age well, then that's why with IRAs are set up so that the idea is that when your income level drops, when you pull it out of your IRAs or your TSP, you're paying at a lower tax rate, so you get to keep more of that money. So the theory is based on that you're going to have less income, but you're going to have lower needs. So that's the theory, but again, as John said, it's specific to you and your family situation. So you look at it and prepare as well as you can, and then you respond to whatever the circumstances are.
Okay, so I am going to, we're going to take a pause on the true or false game. I'm going to go back to our next section, which is income planning in retirement. So we kind of talked about this a little bit, but the first question I have here is how do you optimize Social Security benefits during retirement? So that kind of ties into what we were just talking about.
Well, you know, some of the options with Social Security, claiming Social Security, have recently changed, and it really limited your options on how to maximize things versus the old way of filing and suspending or filing restricted, which maybe you've heard referred to from time to time. Maybe it's not quite clear to you how all that worked, but good news is you don't really need to worry about it because it's much more simple now. What we really focus on most is looking at your family longevity and asking you how long you think you might live, really. I know it's kind of a morbid question sometimes, but if we think that you might live past age 80, there's a real good reason to choose to wait to take Social Security until you're age 70. That's where you're going to max out your payment. So every year that you wait, you're going to get paid an extra 8%. Your annual Social Security benefit's going to go up by 8% every year until age 70. Not to say that we should wait that long if you need to retire and you don't have other funds to fund your income needs in the meantime. But if there are assets there to spend in the meantime, we should be waiting until age 70. Other than that, John, do you have anything there?
Yeah, another way to look at that is if you take it out early at age 62 versus waiting to full retirement age, and if your full retirement age is age 66, then your benefit's going to be 25% lower. And if you're a little younger and your full retirement age is 67, and you take it early at 62, then it's going to be 30% lower. And this is why, again, you want to integrate. A lot of people will wait and take distributions from qualified plans until they're forced to at age 70 and a half. But if you think about it, it might make more sense to access some of those retirement plans from, say, full retirement age to age 70, and let that Social Security benefit grow by 8% plus the cost of living adjustments. Another way to look at that is where can you get 8% guaranteed no risk in the marketplace? You can't, even with a low-cost TSP. And just to put it in perspective, in the last 15 years, and of course we had that huge decline in the midst of that, but the S&P averaged about 4%. So you can get 8% guaranteed, that's pretty good. It doesn't always work that people can do that. I think the number is almost 70% of people take it early before full retirement age. But if you do the planning and realize that you have to take it, that's one thing. But if you haven't done the planning and made the mistake of taking it early, that's another.
How many of us are lucky enough to have a pension? Okay. So my next question is, what is the best way to take pension benefits?
Well, there's really, the two main ways of taking your pension benefit. When you decide to retire, you can choose the full benefit amount or a little bit lower benefit amount if you're married and you want to choose the survivor option. It's going to lower your payments by maybe 10 to 20% or so, but it's going to give your surviving spouse 50% of what your initial benefit was. Another strategy with that is if you are married, not taking the survivor benefit and using the difference of what the lower amount would be if you chose the survivor benefit versus the higher amount without the survivor benefit, taking that difference and purchasing a life insurance policy, guaranteed universal life, full life policy, so that whenever you pass, your partner has a lump sum payout instead of just a 50% reduction in the income that was already coming in the door. So those are the two main ways to think about your pension benefit. If you're a single individual, it makes it a lot easier. There is no decision there to make on survivor benefit. You also want to be considerate of what your highest 3 years of income is going to be with the Fed. So if you're about to retire, but you're about to get a promotion, if you don't retire, you're going to make significantly more income than you have been. Your pension is based on the average of your highest 3 years of income with the government. So if you're going to be foregoing a significant amount of pension income because you chose to retire a few years earlier when you're about to start making quite a bit more money, if you had stayed, you might want to consider that as well.
So I'm going to give you 1 second, sorry. So we're going to, we talked about Social Security benefits and we also talked about pension. So what do you feel are some good strategies to supplement those two?
Supplementing income above and beyond pension and Social Security. No, I'm sorry. One of the, I think, more complicated in implementation, but pretty simple in concept strategies that we employ is a 3-bucket strategy. If you've got your pension income coming in, you've got your Social Security income coming in, and that's on a monthly basis, it's set in stone, you know what that is, but now you need more income than that to live life, pay your expenses. You're going to be withdrawing from your TSP or your 401k, your IRA, or wherever you have your investments. And those are variable, right? Those are going up and down with the market, and we need to keep some for longer term. That should be invested more heavily into stocks so that we actually are getting good long-term growth with the stuff that we're not going to spend anytime soon. But then we need to make withdrawals from it to spend this year and next year, and we can't have that going up and down in the market and running the risk that we're going to be selling out for a big loss when it comes time to make that withdrawal. So a 3-bucket strategy would be any money that you need to tap into out of your savings over the next 0 to 2 years. And that can vary based on individual, whether you want to make it 0 to 3 years or any income that you need to withdraw from savings over the next 12 months. Keep that in cash or cash equivalents. We're not earning much on it. It's not going anywhere though. That's the point. We're not trying to make a big return on that money. So it's gonna be there when you need it. Next year rolls around, that money's in cash, and you can spend it when you need it. That would be bucket one. Bucket two is any money that you need to spend over the next 2 to 5 years. Let's separate that off into something that's also not going way up and way down with the stock market. Typically, we're going to use a diversified bond fund to do that. We can also use inflation-protected bonds, so that if interest rates rise, I mean, that's the big risk with bonds right now, is interest rates are low. We think interest rates are going up at some point. They've pretty much only got one direction they can go at this point. And when interest rates go up, bond prices go down. So if you hold money in a diversified bond fund and interest rates go up, the value of that fund that you hold is going to go down, at least to some degree. So inflation-protected bonds is something that you can hold in that second bucket to supplement that if interest rates go up. You've got some in those inflation-protected bonds that you can withdraw that money come time for a withdrawal. And that would be between 2 and 5 years from, say, right now if you were retiring today. And then bucket three would be your fairly standard diversified stock and bond portfolio. Let's base the risk level that you take on. Let's base that on your need for growth over the long haul. To run an analysis on your situation and determine whether what do we need to hit, 6%, 7% average annual return, or maybe you need to hit 9% really to make it all work long term. Well, based on the amount of return long term that we need, we should be investing a little bit more conservatively or aggressively. But then there's the emotional aspect to risk, right? So if you're not sleeping at night because your investments are too risky, well, we need to consider that as well. So we'll find some sort of balance there that fits for you, works for your situation, you're comfortable with it, and we're getting the long-term growth that we need. But that would be everything else, 5+ years from now, whatever you need to tap into 5+ years from now, that's in bucket three, and it's your standard growth portfolio of stocks and bonds. So.
Did anyone want to add anything else? Questions?
Yeah, I had a question going back to the survivor benefit for the annuity. Were you assuming that the surviving spouse is not also a federal retiree? And I ask that because some people have said that if you're both getting annuity, federal annuity, don't do the survivor benefit. It doesn't make sense. I don't know if that's the case or not, based on whether you still have a mortgage or something, or you're both contributing or whatever. But if you could address a little bit sort of the scenario, because I don't know how common it is in this room, but I think a lot of feds are married to each other, and therefore they both will be getting the same benefits, and therefore it's not quite the same as, say, a work-at-home spouse, right? That doesn't have that kind of annuity.
That's a good question. Yeah, a lot of government employees are married. The question is, do you need that income, right? It's going to drop off if you've made your financial plans around having both of those incomes coming in, and then all of a sudden one of you is gone. Now you got, what, maybe $3,000 a month that's not coming in anymore. Did you need that income? Could you have used half of that, right? Because that's what the survivor benefit would be.
And that's where you should consider things like whether you still have a mortgage.
Absolutely. It's going to be on a case-by-case basis where let's look at the expenses in your situation and make sure we've got them covered. If that can be, used, then maybe we should consider it. But yeah, it's great when there's two pensions coming in.
Any additional questions?
How does working at Social Security interact? I don't quite understand like how much you can earn and still without affecting your Social Security benefit.
How much you keep? I'm not sure I understand the question.
In other words,
There's also a sort of cap.
Yeah, you're taking it out while you're still working?
so if you retire and get Social Security and then want to have some additional income and work, isn't there a limit on how much you can earn?
Yeah. They'll withhold some on you if you're still working and you haven't reached full retirement age. If you reach full retirement age, you won't be penalized or held back.
Is that 66 or is that?
So it depends on when you were born. It's between 66 and 67, depending on your year you were born. For instance, I was born in 1956, and for me, it's 66 and I think 4 months. So up to 50% of your benefits may be taxable, though, if you're taking it out, prior to. And I think the cutoff now is once you take it, if your benefits earning more than 16,000.
I have a question on the full retirement age, so 66 or 67, but it still continues to go up though if you don't draw, right, up to age.
From full retirement age up to age 70.
Well, why
At age
did-
70, it stops.
So why do they use the term full retirement age?
Because it does change depending on what year you were born. So full retirement age might be 66 for someone sitting in the room. For yourself, I'm guessing it's 67. And so the benefit will grow by 8% plus the COLA, each cost of living adjustments each year from your full retirement age until age 70, and then it stops and there's no benefit to delaying past age 70 even if you're still working.
So if I took it at age 62, and compared to if I took it at 63, 64, does it go up 8% each year, like from 62 to 63?
It's actually, I think it comes out to 6.2% between 62 and full retirement age, and then 8% from full retirement age until age 70. So it's a little bit different. It's not flat across the board. And yes, I think they do it every month, so if you don't have to be there a full year, do that half a year beyond, you're getting a half year's lunch.
Do we have any additional questions?
I just want to add one thing on the whole Social Security question. It's very interesting, and we do have some workbooks. If you contact us at the end, we can email you or send you hard copies of Social Security workbooks, and you can compute basically break even. How long do I have to live if I don't take it at 62 and I wait until full retirement age? What's the break even if I wait until age until 70 to take it? And basically that's going to range between about age 78 and 80 or change, depending on whether you're married or single. There's a lot of nuances to it, especially with spouses, if the spouse is involved. And that's something that you really should look into, and we can help you with, and we do free Social Security analysis.
All right, so why don't we get back to our true-false game? So if you all can take out your sheets again, if you look live, you guys, please make sure that you enter your comments, your answers into the comments section. So my next statement is, when I retire, I will need to dramatically shift my investment portfolio from stocks into bonds. True or false?
If you were paying attention, you'd love it.
Yeah, so hopefully their answers, I think their answers help you out a little bit. Okay. Don't follow me, guys, I'm learning too. Okay, so it looks like the room is saying false. Did you get that one? All right. Wonderful. Okay, and the last statement I have here, 5% per year is a safe withdrawal rate during retirement. True or false? You lost some people with that one. I'm going with it. What do you guys think? So I'm going to repeat it? Sure. So here's the statement again. 5% per year is a safe withdrawal rate during retirement. We're going to get the answers anyway, you guys. Okay, so it looks like the majority is saying false. I said true. As I said, don't follow me.
The answer is a trick question. No. Truly, it kind of depends.
Depends.
You got there.
There you go.
But we should have defined it a little bit further. Traditionally speaking, if we're talking about a safe withdrawal rate, meaning we're not going to deplete that asset down to nothing anytime soon, then 5% is not so much a safe withdrawal rate anymore. It may have been historically a safe withdrawal rate in years past, but now we're looking at more around 4% or even less if we want to be on the safe side to make sure that we're not spending that asset down. 5% is maybe a good withdrawal rate to spend, any lump sum down over the next 20, 25 years. But if we want it to be sustainable for a long time, let's do 4% or less. The reality is that many folks are going to be retiring at 65, 70 years old, and maybe we don't need it to last 40 years. Maybe we just need it to last 20, 30 years. And we could take 5% annually pretty safely, but true answer is it depends on the situation. So.
Yeah, I will add, again, being the oldest one up here, that used to be the going rate, they used to say. If you took out 5% a year, that would last you. And historically, that number would take you typically past age 85 with the numbers. But people, as we talked about earlier, are living longer. And so 5% traditionally would not take you into your 90s, where people may be living now. The other thing is that when you look at historical numbers on the markets and their performance, these diversified portfolios, they're incorporating a time where bond and fixed income rates were much higher. So if you've got a diversified portfolio that's getting less on the fixed income side than 20, 30 years ago, that's also going to impact that 5% now. And so now the new number that you typically hear is 4%, to carry you through. But again, as Michael said, it's really will play out the individual situation.
Any questions or comments? Yes.
Yeah, I have two questions. One is regarding annuities from your TSP in terms of, we haven't really talked about if you want to pass your wealth on to your kids or grandkids. So I would assume that if I can pass on my assets from the TSP to my kids or grandkids, but with an annuity, I'm not sure if that just cuts off when I die and my wife dies, for instance. So if I'm interested in passing on wealth, then I might not want an annuity. And then my second question regards this last question as far as the 5%. If I want to withdraw 5% from my TSP and put it into a Roth IRA, that's permissible, correct?
As long as you have earned income still. If you're not working anymore, then you can't contribute to the Roth IRA at all.
Okay.
You have to have it up to the amount that you're contributing. You have to have at least that much earned income in the calendar year for which you're contributing for the Roth IRA.
Does that include both my wife and my income? So, for instance, if my wife has a TSP and I'm still working, can I then just put it, take out the 5% from her TSP into a Roth?
You technically can.
Yeah, okay.
Technically.
Yeah, but it would be my money going into the Roth.
Right, it would be considered your earned income going into the Roth. And you can even make a spousal contribution to a Roth IRA set up in her name. But it has to be, quote unquote, your earned income. So.
Any other questions? Oh, I'm sorry.
Keep the first question.
Regarding passing on the income.
Yes, the annuity question. So it really depends on what annuity you choose.
Okay.
There's a difference between investing in an annuity and doing what's called an annuitization. If you have annuitized your money, you've given up access to the principal. You don't get that lump sum back. If you pass away or during your lifetime, you get monthly or annual guaranteed income for life. The lump sum goes away. There are deferred annuities that still have some sort of growth component to them, whether it's based on the stock market or an index or just a fixed rate of interest. And there are annuities that will allow you to take a guaranteed annual amount from that even without giving up access to the principal. And whatever the real market value of what is left in that annuity when you pass, that can go to your heir. But not when you annuitize those funds. So it depends there.
And the TSP would offer all those options?
The TSP will offer those options. They'll give you a limited selection of a few of those options. There are many more companies that do annuities out there, and to get access to them, really all you have to do is roll your TSP plan into an IRA and then buy it with any annuity company that you want to. So you're going to want to shop the marketplace and really determine whether an annuity is appropriate for you in the first place. Because that's another way of supplementing retirement income above and beyond any Social Security and pension income that you have. But we have to understand the reason why we need that, and then shop it out.
I'm going to move on to...
I'll just say one thing. One component you were talking about providing for children. With annuities, again, generally it's spousal, so that's where life insurance comes in. So if you're saying, and that's what particularly for young parents too, if you have nothing else, you should have term insurance, because if one of you are gone and you lose one of the incomes, that's how you're going to pay for their schooling and everything else. Or if later on you're like, well, I'd like to leave a little more to the kids, and I've got some extra money, and my health's still reasonably good. It's a great leveraging tool, because you can pay, a certain amount of money and get quite a bit more back. That's immediate cash and after your death. So it's a great leveraging tool if you're trying to help your kids out.
Well, that was actually an excellent segue to the next section of the presentation, so thank you, Bill. So our next section is going to cover insurance and retirement. So my first question is, when is the best time to sign up for Medicare?
Okay, I'll take a step at that one. So Medicare, if you've retired and you're not yet 65, you want to sign up for it within a window of 3 months before the month that you turn 65 and 3 months afterwards. You don't want to miss that window, or you could suffer penalties on Medicare. If you're still working, you have 8 months from the time I should say, if you're still working and are covered under a health plan from your employer, then you could extend beyond that time period and sign up for it within 8 months of either leaving employment or losing the health care plan at work. So it's something to keep in mind, and don't get thrown off by the fact that Medicare, you want to sign up for that before you hit full retirement age of Social Security. Sometimes people think it's the same age, and it's not. Full retirement age is different than the Medicare sign-up age.
It's important, and also I'll just add on, John, it's important to sign up for your Medicare within the parameters of John, because otherwise you can have your premiums increase for the balance of your life if you don't sign up within that window. So this is not one to, well, I'll get around to it. Make sure, it's worth the effort, because again, if you live 40 years and you add up those additional dollars, it was not a wise decision.
Could I just ask a quick follow-up question to that?
Sure.
Why do they make it that way? I'm not sure the logic of it.
Well, because some people can say, well, my spouse has great insurance, they work with such and such, and got great insurance, and I'm going to stay on that. And so they want. I mean, that's a damn good question. I haven't thought of that. I think they don't. The thing is, I'm surmising this, but I believe that they're like, you need to make a decision. Either we're going to be
You
on
want everybody in at 65.
Yeah, if you fail to do so, they're offering it up to you. And again, if Medicare, a lot of people wait for retirement. They don't retire until they get their Medicare. Like, I got to have my insurance before I can retire. And so, because it is, it is overall a darn good deal. That, I think they're like, we're giving you this option, and if you fail to take advantage of it, it's just like the TSP or the requirement distribution. You don't take your money, we want 50%. I mean, but I am going to.
Just a shock, my colleague next to me just mentioned it, it's the risk pool.
Yeah.
So, the more people in there, because, in your scenario, I'm going to wait, my spouse is working, I'm going to take a 75. All right, I'm a higher risk now, and I'm going to raise it for everyone else versus you mitigate the risk by putting everyone in at one period of time, they can spread it out.
I want to get on a chair and put her up here.
Guys, you got another question?
Yes, I just turned 64 and a half. In the last 3 weeks, I have been inundated by insurance companies offering supplemental Medicare insurance. How do I think through that? Do you guys provide that service?
We are about to. So how do you think through that? Contact one of us afterwards, and we'll take you through that and do an exercise workbook on it, just like we would with Social Security.
And the long story short is we have specialists that we can use to review your specific situation and shop the insurance out for you. We're now just bringing in somewhat of an in-house solution for that, but it's still brokerage type platform.
Well, and also, it's Medicare supplemental insurance is what it is. It's an insurance. People may not even know what it is. When with Medicare, you have deductibles. You go to the hospital, and it's like an 80/20, and so you will still get a bill. It's going to be very much reduced, but depending upon which policy you pick, and they're lettered alphabetically, it's like A through M or A through O, and they took some letters out, but there's something along those lines. And what happens is that they will pick up your deductibles. So if you have a supplemental, as opposed to saying, oh, you went to the hospital, had surgery, here's the bill. You send that on to the supplemental, and they'll get some, if not all, of the deductibles. So it's a very good thing to have. ARP is, they have a lot of plans. Information you can read up on their website on it too. But it's a great idea to have, because it's not terribly expensive, and one bad medical visit, you could pay years of premium.
I'm going to move on to the next question, and then I promise I'll ask for additional questions. So my next question is, how do you decide if you need long-term care insurance?
That's a good question, because the long-term care policies, can be expensive, and there's a lot of individual decision-making that goes in place there. For instance, some people might think that they have enough assets that they can self-insure, and that may well be the case, but they may be underestimating the costs of long-term care insurance. We live in a low inflation rate environment, generally speaking, but not a long-term care insurance, not a long-term care rather. And as we talked about earlier, people are living longer, and consequently, life insurance is getting less expensive, but long-term care insurance is getting more expensive, and there's some competitors that are just dropping out of the marketplace altogether, which will further drive up premiums for long-term care insurance. But I would say that you shouldn't be shy away from looking into it just because of that. You really need to do the individual planning and find out just what it would cost and what the benefits would be, and measure that against your individual situation, your assets. One of the things that will, of course, come into play is who are the beneficiaries of your estate and the assets that you have, and how important is it that there's something for them to inherit. You may have even just a strong feeling that you want to pass on some assets to children and grandchildren. I speak with a lot of grandparents who seem to care more about passing off to the grandchildren than the children. Should have been nicer, I guess.
Most of the people in this room may have the federal long-term care option, right? If you're government employee? Yes, I've seen some nods. And Bill, you're somewhat of a chronic care specialist.
Yeah, and I have a very strong opinion on this. Everyone should consider it. Because see, there's three options. Look, grandmother falls, breaks her hip. We're gonna start with that option. That is, the kids come into my office, and there's three options to pay for her care. And the cost of care, too, we're gonna get into that shortly. If she is at the highest level, there's three levels, independent, assisted, skilled, is over $10,000 a month. Medicare Potomac, we're in a meeting on today, they're at $12K a month before the add-ons. So I don't care how well these guys invest for you, if you pay $12K a month, you're at 4% number, that makes 4 look like chump change. So everyone should consider, because there's three ways to pay for long-term care. One is write checks. You just take that money that you earn and just write the 12K checks. Doesn't take long doing it in the wind. This doesn't feel very good. The second is long-term care insurance, because when grandma comes in, the first question I'll say, does she have long-term care? Only 5% of the U.S. public overall has it. Most people, when I ask the question, they say no. So I said, okay, well, the other third and final option are entitlements. It's either VA, Medicare, or Medicaid. And that's it. Those are the three ways to pay. Now, some people can't afford it. Some people can't get the insurance. Bill, that, you know, I'm just getting over brain cancer. Like, Bill, you know, thanks for the application, but we're not going to underwrite you. But everyone should consider it because, again, I mean, they're talking about inheritance. I've heard people call it inheritance insurance. Because, see, you insure your house, you insure your car, you insure your life. Once you're over 60, the greatest risk by far is a chronic condition. And so, you know, while it's not for everyone, it should be at least a consideration. Because see, what happened, the product's only been around for 30 years. And when they first came out, they underwrote it poorly, meaning they underestimated their claims. Well, a lot more claims came in, so they raised premiums, hoping that the older people would just say, I'm not going to pay anymore, that's outrageous, they doubled my rates, and so they got 30 years of premium. And, or they, you know, and so what they've done now, you pay more and get less because of the poor underwriting. Doesn't mean you shouldn't get it. It means, you know, and again, you may, but with Medicaid, they have that will pay for 70% of the long-term care beds. One of the things they have is a 5-year look back. And so what some clients do is they buy 5 years of long-term care insurance. So if they get sick, they got the insurance to cover through the window, and then thereafter, the entitlements kick in. So you should consider it. Whether you choose it or not is your decision in consultation with your financial advisors, but if you don't have it, you get to see me. And that's a really bad thing. Generally.
Well, you talked about the importance of long-term care insurance. Assuming by what you've said, I assume that life insurance is just as important, but could you kind of go into why is it so important to have life insurance?
Well, life insurance, you need for young families is the most important because, again, the risk you have, I mean, the people who will suffer is going to be your surviving spouse and your kids. And so there's almost no plausible explanation for not having it. Now, once the kids are through college and you got the tuition paid and the house paid, if you've been pretty good kids and I'd like to help you out, then it is a great leveraging tool to do it. But again, I have one couple that they're worth $7 million. They both were fed, saved every penny, put it in the stock market, and they had 2 nephews who lived locally. And he said, had they ever sent a Christmas card, a birthday card, you know, stop by once, they'd have gotten it all. They never did, so it all went to charity. But the point, and again, so it depends on who you want to benefit. I mean, if they don't send the cards, they'll get insurance. But if your kids do go to our acquaintance Walmart, then you might want to say, well, because it's a great leveraging tool because you have some additional income, you have some extra funds, retirement's going pretty well. You can buy insurance. They also have what's called second die insurance, which means when both Bill and Kate pass, then the kids, You know, and the underwriting's better because it's 2 lines, and then at that point in time, there's, you know, you can buy more insurance for less dollars. So just like long-term care, you should consider. Whether you get it or not is your call, but it's part of the, okay, there's no one size fits all. If there was one size fits all, everyone would just line up again. But it's not the case, you know, because every family, every individual is different. And it'll change over time. It may be that I had the policy, the kid was behaving himself, now I don't like his spouse, so guess what? That policy's gonna lapse. So all these warrant your consideration. And again, the great news is you get to make the call. What's right for me? If you take the opportunity, if you don't, then our friends here on Capitol will make decisions for you, and see how well that goes.
So the key is to get a birthday card. Don't skip birthdays, don't skip the holidays, make sure you're buying cards. Right, exactly.
That's the best investment you ever made. And
right,
I think it's gonna
exactly. Michael, did you want to add to that?
No, that's there's a lot of details on, you know, what type of life insurance policy to buy. Those are all things we can help with. That's a whole other conversation, but understanding what's important to you with leaving a legacy. And there's federal estate tax, state estate tax. If you have a high enough net worth, maybe we should consider some life insurance for, but that's case-by-case basis. Identify what your values are, and we can go from there with that. Federal long-term care insurance, I just wanted to touch on that really quickly. That's still, for all you government employees, that's still probably one of your cheapest options for long-term care coverage. Even though they jacked up the rates here recently by like ×2, if you were paying $100 a month premium in the past, you're probably paying $190, $200 a month now to keep the same coverage, and maybe even a little bit less coverage, and still twice as expensive. It's still cheaper than what you're going to find elsewhere. The thing to be mindful of, real quick, is that the Fed policy has a daily benefit option versus a monthly benefit option, where you can find a policy outside long-term, outside the Fed, and get a monthly benefit, where if you have a few expensive days out of the month while you're receiving long-term care, a monthly benefit is more likely to cover it. Whereas if you have like $150, $200 a day of coverage on a daily benefit policy, if you have a $1,000 day because you needed somebody to come, you know, do some, you know, whatever it is for you, then anything above that daily benefit is going to be out of pocket. You can't get that with the Fed. You can't get that monthly policy or monthly benefit with the Fed. And you also can't do a shared pool of benefits between you and a spouse with the Fed policy. You each have to have one. Whereas it's very likely that out of in a couple, one of you is going to have a long-term care need over your lifetime. Well, if you have a shared policy, because this stuff is expensive in the first place, either one of you can tap into the benefit of a shared policy. Whereas the Fed policy, you have to have standalone, you know, your own. So that's all I wanted to add about the federal long-term care option.
I'm going to move on to our next section. After that, then I'll get questions from the audience. So our next section is estate planning. So my first question is, how should you arrange your estate to save on taxes?
Or I'm going to take that one. The good news is that when I started practicing over 20 years ago, the personal exemption for federal state taxes was $600,000. So if you had a house, a car, an IRA, you lived in the metro area, you had a taxable estate. The tax over $600,000 was 50%. Everybody had taxable estate. Today, that number is at $5.45 million. And that's per spouse. So if you add those two together, you and your spouse can pass $10.9 million with no taxes. And I want to solve the problem for you. I'm wishing that problem on all of you. I hope it happens. Every one of you, I hope it happens, and I'll do the documents for you. But the fact is for most people, federal estate taxes are no longer an issue. And it's indexed for inflation too. It goes up about 100, 120 a year. So that solved the problem for most people on the federal level. Now, the state level, it's still an issue. Virginia does not have an estate tax. Maryland has an estate tax that's $2 million per person. And in January, it goes to 2.5 per person. And if you're married and you structure it properly, you could do it so that neither spouse pays taxes during the survivor's lifetime. DC, the estate tax is over $1 million. And everything over, like if I die, everything over $1 million that I give, if I don't structure it properly, they're going to take 16% of everything in excess of $1 million. So you may not have federal estate taxes, but depending on which jurisdiction you live in, Maryland, and the Maryland tax over $2 million is also 16%. It's something to be aware of because, and again, people have, all your assets count, the insurance counts. So you might say, oh, I'm not even close to that, but if you add all of the assets up, it can put you over that amount. So if you live in those jurisdictions, pay attention when you're doing your planning. But the good news is, if you plan well, you can avoid or completely eliminate, you can diminish or eliminate those taxes. And that's why getting a professional to do it is a good idea, because they know the rules and can make sure that based on where they are today, you're not going to pay any taxes. It used to be a big issue. It's the state, on the state level, it's somewhat of an issue, but again, the states are in competition because Virginia's saying, come over here, big corporations, and you don't pay any taxes. And so that's why Maryland was at $1 million. It went to $2 million. January it's going to 2.5. 2018, it goes up to 5.45 million at the federal credit level. DC is going to have to follow politically because they're going to lose corporate citizens and thus revenue. So they have a bill in place that says when they hit a certain level of tax revenue, it kicks in. But it was teed up before the last election, and then this administration hasn't gotten around to it yet. But politically, they're going to lose business, so that will probably change too. So taxes are not as big an issue as actually getting the documents done, which every state gives you the ability to do it, and prefers that you do it. If you fail to do it, then that falls on you and on your family for your plan failing point.
So as a follow-up question, is there a way to completely avoid probate?
Probate is the court system that oversees the retitling of assets when one dies. It's court administered. There's each jurisdiction has one. But it only covers assets that are individually titled. So if I have a brokerage account, my credit union account, if everything's in my individual name and I die, then I have to go through court. And so the word probate stands for unimpeachable honesty. And the reason they have probate is for centuries people have been unimpeachably dishonest. Bill's dead, so he's not come out and take a little here and there, He seems to be fine. He looks happy when they buried him. So the probate here is to make sure that while Bill's gone, they do what the hell Bill said to do. But if I'm giving it all to my wife, Kate, what's the worst that can happen? Is she going to steal it from herself? Well, I guess she could. I don't know if it's worth the effort. But so the need for the oversight, most people usually are giving it to their loved ones, so like to get it anyway. I don't really need, and probate, the hard thing of probate is not the tax, it's $1 per thousand. So it's not a big tax. You have $100,000, you use $100,000, you pay $100. So the tax not huge. It's the administration. You got to go downtown. You got to go to the register of wills. You got to give them a original will. You got to give them a death certificate. So if you say, well, I want to ways to avoid it, or one is I can jointly title assets. I put the house in both of our names. I die, she gets it. I can do beneficiary designations like on the IRAs and 401ks. Bill dies, Kate gets it, or kids get it, or whatever. They have PODs and TODs, payable on deaths and transfer on deaths, and these go on your bank accounts, your brokerage accounts. It just says when Bill dies, put this, pay it to someone, or if you designate it to an individual, it goes to them. Because I have a will that pays it all to Michael, but if all my beneficiary designations pay it all to John, it's your lucky day. And the fact is when you do your documents, you get a false sense of security thinking, oh, I've got them done, they're in great shape. But you have to coordinate these and make sure that these are there. Another option people choose to stay out of probate is they use a revocable trust. Because say I live in DC, but I've got a house on the water in, East Shore of Maryland, and I got a cabin down in the Shenandoah Valley. A revocable trust we create the trust, Bill Fraley Trust, and then how we set up probate is we take the assets out of my individual name and put them in my trust name. So if I do all of that, remember probate only governs assets that are in your individual name, so if I pass and everything's at the trust, there's no probate. And so, see, and with probate, and that means, see, probate costs is, it's an administrative process, it takes time, it's a public process too. For $1, you can go get Chief Justice Warren Berger's will in Arlington and his also his list of assets, his inventory. So, and there's a time component. Generally, most states, they have a year for creditors to file claims. Say, oh, your bill owed me money. I want to get paid out of the estate because the creditors get paid before your beneficiaries get paid. So, but with a trust, you don't have